Good afternoon and welcome to the SDI Investor Meeting. It's great to have Stephen Brown, CEO, and Ami Sharma, CFO, and also James Dimitriou, who's the head of M&A. Thank you everyone for taking the time to attend, and thank you SDI for joining me. First of all, we're going to have a brief summary of the business and a quick recap on the full year results that were announced late in July. Just to remind you, SDI has made huge strategic and operational progress and now has a strong team in place to support the next phase of growth. Throughout the presentation, we'll hopefully get a better understanding of the changes that have been implemented over the last year or so, the progress to date, current momentum within the market, and the strategy going forwards. So we're going to keep the presentation part relatively short, no more than 30 minutes. So we will have plenty of time for Q&A, and I've already had quite a few questions coming in from investors actually. Okay, that's all from me. So I'd like to hand over to Stephen Brown, CEO. Good afternoon, Stephen. Over to you.
Brilliant. Thank you, Tessa. Hello and welcome to today's SDI final results for the year ending the 30th of April 2025. You've all seen this presentation. It is posted on the website, so I will try and keep it fairly brief. So a quick run through of the agenda and just a very quick introduction to us. So I'm Stephen Brown, CEO, SDI Group. Joining me is Ami Sharma, CFO, as well as James Dimitriou, Head of Corporate Development. Today we'll walk through our group summary, provide an operational overview, present the financial results of FY25, and discuss our outlook for next year. At the end, as Tessa said, we will of course welcome input and Q&A. First, let me recap on the SDI Group, our business and model. So we are a buy and build group with currently 17 established businesses and roughly 500 employees operating 19 locations worldwide. And in FY 2025, we achieved a total group revenue in excess of £66 million. We operate a decentralised model that fosters autonomy, independence and agility. Our focus is on high growth scientific and processing niche markets, and we have a proven strategy of combining organic growth with acquisitions, having made 20 since 2014. With our operations being geographically diverse, 47% of our direct revenues are generated from overseas markets. Indirectly, overseas revenues are much higher to our strategic distribution channels, although specifically our exposure to the US is low at around 10%. Importantly to our strategy, our buy and build model relies on a compounding cycle of growth. So looking more to our business model, and the model is very much, in fact, our group strategy, and it focuses on two key pillars, organic and inorganic growth. The organic growth strategies include synergies, collaboration, operational excellence, and of course, investment for growth. Cash flow generated from organic activities feeds the inorganic growth, where we seek to acquire complementary profitable businesses in niche markets, and this feeds back to create a compounding effect. We are of course driven by efficient and effective capital allocation. Now to provide a bit more detail on what we are delivering during the year. The year has been focused on executing the refined strategy outlined last year, and it was a year of significant strategic progress where we delivered a solid financial performance and started to see our plans come to fruition. We continued to facilitate knowledge sharing and synergies across the group and supporting portfolio management teams to deliver. Our growth continued to be supported by strategic acquisitions this year, and we successfully delivered 3 excellent acquisitions since we last reported. These include Inspecvision, Collins Walker, and post-year end Severn Thermal Solutions. Also, I'm pleased to report that our business model has demonstrated resilience against a backdrop of continuing challenges and uncertain global conditions, which seem to be continuing. I would now like to provide a little bit more colour on some of our key organic growth initiatives. So we focused on leveraging the sum of our parts, identifying opportunities to improve efficiencies and market access across the businesses. We have continued investment into R&D and new product launches driven by customer needs and requirements in response to market demands. There's been many collaborative incentives. For example, we had a powerful presence at the prestigious Lab Innovations Expo, bringing 6 companies together to promote a unified product offering. Also, we delivered multiple collaborative products and contracts, including between Fraser and Monmouth, Attic and Synoptics, Collins Walker and LTE, and Severn and ATC. We have improved knowledge sharing across the group also. To give you some examples, we are delivering value from our group marketing function that was created last year, and we recently appointed divisional MDs for 2 of our higher growth divisions to improve capacity, capability, and resources to drive organic growth. Let us now look at each of the operating divisions in turn. First up is our INS Products division, which saw solid performance with total revenues up 10% to in excess of £25 million, including Inspecvision, who met expectations. I'd like to call out a few highlights. Attic performed well post-restructuring work undertaken in 2024. This year seeing consolidated operations to one site in Lisbon and Portugal. Fraser's growth was underpinned by increased product awareness in product markets, and we also had a number of new product launches across the division, in particular from ATC, who focused on sustainable product offering driven by regulatory market demand, in particular from the US, and Attic launches most advanced CMOS camera for demanding applications such as neutron imaging and astrophotography. And now to our INS Sensors division, who delivered total revenue growth of 6% to £17 million. We saw solid performance from Centec, driven by increased demand from new and existing customers for both established and bespoke solutions, and a strong capability to market expansion. Chell performed well, as expected, and very much within an expanded product range. MPB had notable growth in end markets, which had driven sales in the period also. And finally, to our Lab Equipment division, where total revenues decreased by 11% to £24 million. This was primarily reflecting challenging conditions in life sciences and biomedical markets. However, I'm pleased that the organic initiatives which we implemented in some of the segment businesses started to have impact, driving a recovery in the second half of the year. SafeLab had an exceptional performance through contract momentum. In addition, they delivered a significant government contract award for the delivery of high quality fume cupboards. Monmouth had its largest ever single cleanroom contract, although this will be delivered during FY26, and is linked to the new SDI implemented strategy to refocus product offering at Monmouth for higher value products. As expected, there were numerous new product launches across the division, and these include LTE's new range of autoclaves with a focus on sustainability, smart performance, and of course safety. And Synoptics launched a focused compact imaging system which targeted smaller niche laboratories. Moving on to our inorganic strategic development, I would now like to talk through our new additions to the group. As mentioned earlier, we had 3 earnings enhancing acquisitions since we last reported, all in line with our key criteria. First up is Inspecvision. This is an excellent acquisition, bringing to the group significant technical advancement in AI and ML capabilities. They will remain autonomous whilst exploring international and other route to market synergies with Fraser. They manufacture precision measurement machinery for smart manufacturing, automated inspection, and reverse engineering. I am pleased to report they had a strong performance post-acquisition, including market validation of their recently launched GAV product, leveraging their in-house developed machine learning technology, having received their first significant customer sale of the new product. Also 2 months ago, they received for the second time the King's Award for Enterprise, validating their quality and strength. Next up is Collins Walker, who provide industrial scale electric boilers for steam and hot water applications. They are a smaller bolt-in acquisition with significant opportunities for growth, with strong tailwinds from regulatory drivers for electrification and the drive to net zero. Being a bolt-in, we will integrate the operations and manufacturing into our portfolio to increase capacity whilst keeping the brand, sales and service running independently. And finally, to our most recent acquisition completed post-year end, Severn Thermal Solutions. Severn will be kept autonomous as part of our decentralised model and manufacture high temperature furnace systems and environmental chambers for advanced material processing and testing. Focused on innovative high value markets such as aerospace, semiconductors and nuclear, they boast a strong blue chip customer base with solid international exposure. They have numerous synergies and cross-selling opportunities within both the lab division and across the broader group. As with all our acquisitions we target as a management team, Severn is yet another high margin business, boasting between 40 and 50% net margins. Now over to Amy for an overview of the financial results for the year.
Thank you, Stephen. Hello, everyone. Looking at the financial highlights for the year, from a revenue and profit perspective, we overcame a tough first half. Full year revenue showed some growth overall due to acquisitions, but there was a small organic decline of 1.6%. The good news is we saw some organic revenue growth in the second half of the year. Adjusted EBIT reached £10 million, and net operating margins improved from 14.5% to 15%. We saw growth in adjusted PBT, and as you can see from the slide, a strong cash performance with over 100% operating cash conversion and £3 million more cash generated than last year. Net debt was only slightly higher than last year, despite the 2 acquisitions in the period. I'm also pleased to report that we've had a strong order intake year, with all divisions up on a like-for-like basis compared to FY24. Turning to the income statement, the £2.8 million acquisition growth came from Peak Sensors in the first half of the financial year and then Inspecvision for the second half of the year. As I mentioned at the half year, there were closed of or disposed of entity revenues in the comparative numbers, arising from Uniform Engineering and Synoptics Inc., and that totaled £1.3 million. After you exclude all of those, the organic revenue decline was 1.6% on a constant currency basis. I'm pleased to report that our gross profit margin increased by 2.8% to 64.9%. This is on materials only. On a like-for-like basis, gross margins were 65.5%. Pricing continues to be a key focus for the group, and this improvement demonstrates the success of our operational efforts. On a like-for-like basis, our cost base increased by 3%, pretty much in line with inflation. The improved cash flow in the year led to lower gross borrowings, and together with the reduced base rates, meant finance charges reduced compared to last year. The tax rate on adjusted PBT reduced slightly to 22.7% compared to 23.5% last year. Looking at below the line expenditure, acquisition costs were £400,000 higher than a year ago due to there being more acquisitions than last year, as well as some aborted acquisitions. Share-based payments returned to a more normalised level this year. The next 3 slides provide a bit more detail on the financial performance of the 3 segments. We start with the products division. This division showed organic growth of 2.8%, with £1.6 million of the revenues coming from acquisitions. I'm pleased to say that the product segment showed good organic growth over the second half of the financial year, about 5.4%. As Stephen mentioned, Attic, Graticules and Fraser all saw revenue growth. Attic through growth in the professional astronomy market. Applied Thermal Control saw a slower market for its chiller products, as its industry adapted to regulatory changes in its end markets. Margins improved through operational efficiencies, a combination of better gross margins, restructuring and operational gearing. Next, the Sensors division. This division saw an organic decline of 1.6%, with £1.2 million of the revenues coming from the Peak Sensors acquisition. This organic decline was largely caused by a post-COVID normalisation of ordering patterns at Astles for their chemical dosing systems, and this follows 3 years of strong performances. As Stephen mentioned, MPB, Chell and Centec all had good years. Chell and Centec saw a heavy second half bias to their performance, which led to the Sensors division showing some organic growth over the second half, just under 1%. Margins largely held in this division at 26.4% compared to 26.8% last year. Next, the Lab Equipment division. Clearly, this segment saw a tougher period of trading with an organic decline of 5.8% over the full year. Safelab and Monmouth both saw a heavy second half bias to their results, and this led to the segment being broadly flat over the second half, and this was encouraging. LTE had a slower period of trading due to a lower activity on environmental test chambers and a slower NHS market. The lower revenues meant net operating margins reduced to 11.3%. Turning to cash. It was a successful year cash-wise, with cash generated by operations reaching nearly £13 million and free cash flow after leases of about £7 million compared to £3.4 million in the previous financial year. Overall, the working capital reduced by £1.3 million, which is a positive outcome. A lot of effort was made into managing our inventories and reducing overdue debtors. This resulted in a broadly flat inventory position at the year end, and debtor days reducing from 46 to 44 at the end of April, with trade debtors reducing overall by about £500,000. Customer advances increased by £0.6 million following a large advance received by Attic in the year. Excluding acquisitions, our working capital as a percentage of sales improved to 18.6% at the end of April. This compares to 19.8% at the end of the last financial year, also excluding acquisitions in that year. The £7 million of free cash flow was used to fund the 2 acquisitions in the period. These cost £7.3 million between them, and this is more clearly illustrated on the next slide. This slide shows graphically the movements in net debt. The £30 million in cash generated by operations is on the left-hand side of the graph and in grey, and our utilisation of that cash is illustrated on the right in black. We ended the year with £13.8 million of debt, excluding leases and deferred consideration, and this compares to £13.2 million at the beginning of the year. So our leverage at the end of the year was 1.1 times net debt to EBITDA, which is within the board's preferred range of 1 to 1.5 times. At the year end, we had headroom of around £10 million, and we have a further £5 million accordion option available at our bank's discretion. There is £0.6 million in outstanding deferred consideration at the year end, and this is expected to be paid in the first half of FY26. It's worth noting that the acquisition of Severn Thermal Solutions in early June for £4.8 million utilised some of that headroom at year end. Now I'll hand back to Stephen, who will cover the outlook.
Thank you, Amy. Now looking forward to this current financial year. For the future, our strategy remains consistent. We will continue to drive organic growth by investing in new product development, promoting synergies, and driving operational excellence across the portfolio, while we also pursue high-quality acquisitions. We enter the new financial year with positive momentum, underpinned, as Amy says, by a strong order book. And while we remain mindful of wider economic uncertainties, we are confident in our resilient business model and the long-term opportunities and drivers within our markets. Our acquisition pipeline remains robust and actively managed, and we continuously review that pipeline, which is supported with there being a wealth of niche engineering and manufacturing businesses, both in the UK and internationally, seeking to exit. Of course, where SDI will be a natural fit and have the capacity to execute on these opportunities. With all of this said, we expect to deliver FY26 results in line with market expectations and are confident in our ability to generate sustainable long-term value for all of our stakeholders. That's all we've got for the presentation, and we will now open up for input and Q&A. Thank you.
Thank you, guys. I've got quite a few questions that have come through. So I'll kick off to start with. The first question, F26 numbers factor in double-digit growth in revenue, but what does the sustainable revenue growth look like in terms of a percentage going forwards? Or put differently, what should the underlying organic growth look like?
I'll take that one. Yeah, so it has acquisition growth in there. But obviously we had 3 acquisitions and you've got the annualised impact in the FY26 numbers. If you look at the organic growth within that, it's circa 5 to 6% in that rate, and that's within the sort of range that we've talked about, which is between 5 and 8%, which is a longer term target. So we are kind of within our range in the guidance for organic. I think that's kind of what the question.
I think there's a second part to that what are the major growth plans for the company in the next 3 to 5 years, and how do you plan to achieve them?
Really, it's about keeping our strategy consistent. We launched this, as I said earlier, really, we've launched the strategy last year, And for us, it's all about consistency, and it's really about delivering to that strategy. Our growth is really going to be as we've laid out, so it's going to be a mixture of organic and inorganic. We do have a very strong focus on the organic, and really we need to improve on that, and we will continue to drive that very hard. We've got divisional directors in who are already making an impact, and we're already seeing improvements in the portfolio businesses due to that strong, dedicated attention that they're giving the businesses. So really for us, we want to be driving that organic growth harder and harder. For that, from the organic growth, what we're ultimately looking for is cash generation, and we are a buy and build. We will continue to acquire. We will acquire as much as we can, but mindful that we will be acquiring the right businesses for our company, and also looking at the margin profile of those businesses as well. As I said, we acquired Severn, which was the last one, which was in excess of 40% net margin. We will be looking at higher net margin businesses to really push that margin profile of the group up, which ultimately feeds back and drops into our cash generation and bottom line growth. That's really what we're focused on. So if you look at the next 3 to 5 years, that's the profile of it. In terms of numbers, I think the more cash we can generate, then the more we can boost those numbers.
And we should continue to be cash generative going forward. I mean, as I talked about the cash generation in the last year, that will continue in the years to come. So we should see free cash flow, 6 to 7 million and growing through thanks to organic growth and organic growth. And so that cash generation again we'll use to fund acquisitions, as Stephen says.
And the next question, I think it's for James. How is the acquisition pipeline looking, and how are the conversations going with potential partners?
The pipeline's looking pretty strong. We've been working on it quite dedicated to managing all of that over the last 12 months. Obviously, we've done a few acquisitions since last year's report, but we continue to meet with all the businesses. I'm out on the road a lot, meeting all these fantastic businesses who are all doing exciting stuff. So yeah, from my point of view, the pipeline's looking good. Every year, there's more people looking to potentially retire or planning for their succession. So it forms a good basis for that. And of course, we're looking now more broadly outside of the UK as well and into international opportunities.
And can you just say a bit more on multiples that you're seeing and how competitive things are in terms of M&A at the moment?
Things will always remain competitive. I think in terms of multiples, I think we're sticking to the same strategy that we've had for a number of years now, which is about 4 to 6 times, depending on the quality of the business and the growth opportunities. So for us, factoring in the quality and, as Stephen mentioned, the operational and gross margins of the businesses, we're really focusing on that side of the quantitative aspects of the businesses, but also the qualitative. What's the culture like? Will they fit in? So yeah, we've seen a lot of competition, but I think ultimately if people want the culture that we can bring, the type of model that we've got, which is to remain autonomous with support and structure around it, then there isn't a huge amount of competition out there realistically. And it's a relationship building aspect. So a lot of the companies that we're talking to, we talk to for months, if not years. So they've got to know us, we've got to know them, and we've built that relationship together and want to work together on, post-acquisition.
And a couple more questions on M&A, but I think more for Ami. Can you just remind us of the breakdown of the contribution to EBIT in FY26 in terms of M&A?
For what? At the profit level?
At the profit level, yes, or just in terms of how many months?
Yeah, we don't tend to disclose at profit level individual transactions, but you should get a steer from previous performance for the acquisitions that we made in terms of their EBIT contribution. So no, we don't tend to share that. We don't give that. Otherwise, we go into it. It gets pretty granular then.
And in terms of how many months or that you've got a full year of one of your more recent acquisitions dropping in, Can you talk about it in terms of that?
Yeah, absolutely. We've got another 6 months of Inspecvision because they joined the group exactly halfway through the financial year. You got a full year of Collins Walker, which is a couple 100K. If you look at the slide from from the acquisition slide, it details it there. You've got Severn Thermal, which is almost a full year actually. It's 11 months because it was acquired in the beginning of June. You can see the EBIT number that they delivered in FY24, I think is the figure on this slide. So is it 24 or is it 20? Yeah, it is 24, isn't it? And so it's almost a full year, 11 months worth.
Okay. And then back to margin potential, you sort of hit at an EBIT level, the 15%. But what's the margin potential for the group over the next 3 to 5 years, and how do acquisitions impact this? I know you said some of the acquisitions are much higher margin now, but can you talk a bit more about that?
What do you want to do? Would you like to get that one?
Go for it. Yeah. You might get a slightly different answer from the two of us, but yeah.
You'll get the positive and you'll get the CFO answer. You get the CFO answer is that it's the most difficult question. I've said this before. I think I even said it in this presentation a year ago. For those of you that were on, it's the hardest percentage to forecast. I would say circa 15% is good. All the acquisitions will add to that, but you do get a mixture effect, because if you get one large contract in one company, it has a large drop through impact. And everyone knows this from if you look at our history during COVID times, our net margins went to between 20 and 24%, if I remember rightly, and that was because we had this huge contract in one company, and that particular company had a net margin of 47 to 50%. So in a long-winded way, what I'm saying here is that 15% seems to be the sweet spot. It'll grow simply because of the acquisition, but that depending on everything else standing still. But I'm expecting that 15% to be the target. We may get to 16 and 17 thanks to the acquisitions, but I think 15 for the current year looks like a reasonable percentage, but we're working to improve it. Over to you, Stephen.
For us, cash generation is everything. Net margin to me is a significant driver in that cash generation. So it's all to play for. For us, we have got a real strong drive to really grow that net margin. The initiatives that we did through last financial year, and we're continuing to do in this financial year, is just going to increase and improve that. Whenever we're looking at acquisitions, we do look at the high margin businesses. So again, that's going to improve that. So we do have a drive to going. If we've got a realistic target, as Amy says, is 15, but targets are made to be exceeded. So yeah, it will continue to be a focus for us.
Yeah, and I mean, on the acquisition side, just to add to that, typically we're aiming for at least 30% margins on that regard. So I think the more acquisitions we do with that kind of quality will bring that up further as well, as Stephen said.
So definitely going upwards, but 15% is at the current sort of target.
And in terms of, again, acquisitions, probably before your time, but some of the acquisitions that have had a more dilutive effect, can you say any more on that, or particularly in the sort of the life science markets? Is there anything that you can add that has held the margin back over the last year or so?
Yeah, I mean, the lab equipment division was largely formed over about a 2-year period, wasn't it? From Monmouth through to SafeLab, and it is fair to say that the margins, you can see it from the slide, that is 11% net margin. Now that will improve because there'll be a significant drop through as the revenues increase. So I could see it getting back into the teens, but it's not a kind of market that you'll see 20% plus, although we're going to obviously work towards that. I don't see it getting to 20% anytime soon. So yes, it's true to say that the lab equipment division is a lower net margin division than the others. You can just see it from the numbers.
However, we've got Severn Thermal has joined the lab equipment division, which will start bringing that up. We won't account for it this financial year, but next financial year you will see those margins.
And a lot of our margin expansion initiatives are in the lab equipment.
They are indeed.
And so you're seeing us working on it, and so there'll be a combination of drop through of higher revenues as well as margin expansion efforts that we're working on, some of which Stephen's talking about. So it will improve, but it will not be at the level of the other two divisions, I don't think.
Thank you. And could you talk about the main factors that typically drive working capital swings in the business? and how we should think about those as SDI grows. And just on that, how do you approach CapEx plans for the next few years?
Yeah, okay. So what drives it? Customer advances really is one of the big variables in our balance sheet. It rose to about 5 million almost through COVID times, and then it dropped down to 2 million, which is one of the reasons we saw a year or two of low cash generation. We had about 500,000 of cash advance increase of about 600,000 over the last year, so that contributed to the cash performance. So customer advances are a big feature of our cash flow generation and the movements therein. So if you have and those are hard to predict, to be honest with you. You can get one on the last day of the year, and that will distort our working capital. So the other factors, obviously, just the bog standard stuff. Really, we work really hard on inventory management and debtor overdue debtors. It was as simple as that, really, not much more complicated. And our structure actually helps us with inventory management because we've got so many businesses out there that when you do, they're pretty good at managing their inventories, most of them, and they're very close to their inventory positions, and we give them a clear direction of what we want to see, which is below 6 months worth of stock. So it's a long-winded answer, but customer advance is probably the biggest. And we'll try and manage the inventory working capital increases as our sales grow.
And just on CapEx plan.
Oh yes, of course. Yeah, sorry. 2%. We're sticking with the narrow 2% of revenue range. There are going to be two or three ERP implementations at some businesses over the next couple of years, but I don't really see it going that much beyond 2% overall, 2.5 maybe tops. But I think it'll average out over 2% of revenues over the next 2 to 3 years. We have no big CapEx plans to the new building or anything like that here and there. We haven't got any of that at the minute.
And there's a related question on that. Is that level of CapEx enough, assuming most of that's R&D, compared to the percentage of revenue, looking at numbers for FY26?
Is that sustainable?
Is it enough, the sort of 2 to 3%?
It's a good question. It's a very good question, yeah. I mean, these are small businesses. They run a light asset model, most of them. They don't need a huge amount of CapEx. And there's lots of small businesses who run out of, units, dotted up and down the country. We could invest more, and we never say no to anyone, to be honest, do we? So it's up to the business to come and tell us when they want a large piece of kit. We try and share equipment as well across the businesses. When one business, that we've had 2 or 3 instances where we've shipped unused kit from one business to another because we've improved the communications between the businesses. So yes, I think it is enough actually, and we will invest in them. We won't hold that back, to be honest with you, because that's the best. Investing in them is what we've invested, for example, in Graticools. I'll give you a good example. They're pretty heavy equipment. They machine bias in terms of improving margins, and we've seen the benefit from that over the last year or so, where they've grown quite dramatically. So we'll continue to invest. We don't hold it back.
And because we tend to pace it, so it is 2% every year, and we try and encourage and manage the businesses to budget for it at the beginning of the budgeting cycle, so that they can preempt exactly what they are going to spend, and we do encourage them to spend it, but because it is consistent year on year, we do keep up with it rather than having a spike 6% one year and 1%. We try and keep that nice that flat consistency.
And we will know about it because we do strategic planning meetings every year, and then they will tell us if they need to do something, move site or whatever. Doesn't happen, but as an example, they'll tell us if there's a big piece of CapEx required, and there isn't at the minute that we know of.
And a second part to that question is, how do you measure return on investment versus product development spend?
Yeah, so that's a good question, actually. So we monitor the return on total invested capital overall for each business as we go along through the year, over the years. In terms of future product development, we tend to look at it on a project by project basis. We tend to look at the return that particular investment is required on a project by project basis. We do it at that level, and we do it at the budget time as well. And we don't necessarily set a hurdle or anything like that, but we will evaluate the R&D spend at the budgeting cycle.
And also on that, what percentage of revenues come from products launched in the last 5 years, or as the question is worded, or some other vitality measure?
I don't have that in the statistic actually for you. We don't necessarily measure it.
And I don't see how we could. The markets we operate in are fast-paced markets. So for us to keep our market presence and dominance, we have to continuously look at the products. We have to upgrade them. We need to replace them. We need to keep that momentum of product development and NPI momentum going. Otherwise, we will lose market share.
And given our business model, it's virtually impossible to work that out. If you consider we've got 17 businesses all doing different investments, trying to work that statistic out is virtually impossible, I would suggest. It wouldn't mean anything anyway, even if we worked it out.
Yeah, I mean, new products is a grey area anyway, because you've got iterations of products which are launched into new markets. So,
yeah. Most of our product development is upgrades and improvements to existing products rather than complete brand new products. Which is quite important to keep pace with the market. The good news is that we're not losing market share in any of our businesses, which shows that we probably are keeping pace with the market.
But we are exploring new markets, aren't we?
Indeed.
What sort of revenue base can the current central overhead cope with?
Well, that's a good question. You know, we've obviously added 2 heads at the centre, being divisional heads, and they allow us a bit of more management bandwidth than we've had previously. So they can add 2 or 3 more businesses each, at least.
Yeah.
I would say.
At least.
We don't necessarily need that many more headcount at the centre, I don't think.
We don't.
And we can go for another year or 2 without really adding. I think that's the current plan.
And whenever we're at a head, we always look at the return on those heads. We just don't add cost for cost's sake. We expect to see a return, and that return for the 2 heads brought in will be organic growth.
Yeah, but we'd reached a point where we needed some more management bandwidth, I think, and so we went out and got that.
And the next question, you talked a lot about the group strategy that's now in place, but can you just give a bit more detail on the long-term growth drivers for SDI?
In terms of the market?
In terms of the market, yes.
Yeah,
that's a very difficult one to answer because we've got 17 businesses. I think quite interestingly, quite strategically, we acquired Collins Walker because we see a significant tailwind there with sustainability and net zero, for instance. That's going to be a driver for us.
Clean rooms?
Clean rooms is also going to be one. Globalization is also going to be a significant one. Breaking into new markets is going to be quite significant for us. There's a lot of large geographic markets that we just simply don't operate in. I think Japan is quite a good example there. And we've just recently broken into South Korea with Fraser. Asia in particular is quite slow. US, again, for us, historically has been too small for us, and we really need to be growing there. So I think that's probably where our main growth is going to be geographical.
I mean, people say to us that 10% of sales is to the US is, they feel some reassurance. But actually, if you ask me, it should be more than that. Actually, we should be doing better in the US. We actually need to do more in the US as a business.
Absolutely.
It's a massive market, and tariffs don't really matter. Actually, we just need to do more in those jurisdictions. That's just the cost that has to be considered.
Okay, we're coming to the end of the questions, but one of the last ones is, can you provide a bit of colour on the order intake and the performance so far this year? Are you performing well above last year?
For FY20, which year are you talking about? FY26?
For 26.
26.
Well, we haven't commented publicly on any of that, so we can't really talk about it, but it's been fine so far, is what I would say.
Yeah. We've got double-digit percentage above the same time last year.
For FY25 versus FY24.
FY25 versus 26 was the current year.
But 26 has started fine. There are some orders in the pipeline which are going to be quite significant ones for the current year, which we're working upon, which should come fairly soon. But yeah, it started okay in terms of order intake. But yeah, we haven't said anything publicly, so I can't really say anything any more than that.
We've closed the first quarter really as expected, strongly.
Yeah, so we're trading in line. We're doing all right.
And anything else to add on the sort of current momentum?
No, nothing more to add, I don't think.
Yeah, I think we've pretty much said certainly all we know at the moment.
So we'll be issuing a trading statement in about a week's time, week and a half, when we do the AGM, the trading. When we have the AGM, so on the 24th, we'll put out a trading statement at that point. That will cover it, but don't get too excited by it. That's my comment.
Yeah, indeed. We've been communicating that our expectations are strong. We're in line to hit market expectations.
Yeah, I think so.
That's nothing has changed to really perturb us from that. Nothing at all, in fact.
We're still as confident as we were a month ago, so we're happy.
Okay, I'm conscious that we are approaching the hour, so thank you very much for all the questions that have been submitted. Stephen, Amy and James, thank you for your time today, and also thank you to everyone that joined the presentation.